Major averages, though, still on pace for a third straight week of losses. Despite that tough tape, our next guest still sees some buying opportunities in September. He's Ed Yardeni. He's the president of Yardeni Research. Welcome back. Interesting notes from you. You say, quote, we've seen both the highs and the lows for the rest of this year. So where does that leave us as investors?
Well, it probably leaves us as exactly as I suggested in a trading range. Question is, are we going to be closer to the lows or the highs by the end of the year? I think we'll be closer to 43.05 than we're going to be to 3,666. We have an economy that's growing very slowly. There is a sort of a rolling recession that's hitting different sectors at different times. Right now, the housing industry is obviously suffering quite a bit. Some goods producers are saying that there's been a shift by consumers away from goods to services. So I think that's kind of the nature of this beast. I don't think we're going to have a traditional recession that's caused by an economy-wide credit crunch.
You know, I've been describing this market as rather binary. It's either you don't fight the Fed or you don't believe the Fed. And it finds me here suggesting that you don't believe that they're going to hike as much as the market might fear, and that you're still banking on a pivot, much like the professor at the top of our program was talking about.
I'm not really banking on a pivot. I'm banking on the Fed being data dependent. And I think the data is going to show, especially as September 13th, I'm counting on a really good number on the CPI. We know that gasoline prices came down tremendously in August following a big drop in July. We know that used car prices are coming down. I think we just had the purchasing manager survey today, and we saw that its prices paid index has come down a great deal. So I think the fundamentals are going to start improving. Some of the inflation was supply chain disruption related, and I think there's more and more evidence that that's behind us. So the question is demand, and I think demand is slowing. It's certainly pivoting away from goods to services, and that should also help to kind of cool things off. So I hope the Fed goes for 100 basis points at their next meeting at the end of September. Just get it over with. We're 2.5 now, the top end of the range. Let's get to 3.5. Markets are already there. That's where the 2 years at. The bond deal is basically anticipating that kind of move. So the credit markets have already tightened, done most of the work for the Fed.
Well, the credit markets have forced, certainly the bond market has forced the stock market to catch up to it on numerous occasions. So that's what we sort of just went through. The question is, are we going to have another episode of that? Now, given all of this, if you think we're going to be in this trading range, we teased this out, suggesting that you still think there is opportunity to be had. The question I want from you for our viewers is, where is it?
Well, I think technology, as we saw during the rally from June 16th through August 16th, a lot of the sectors that were beat up prior to that had a tremendous rebound. And I think you kind of want to stay with those kind of stocks because they are going to do well if the economy doesn't head into a terrible recession as is widely feared, or the Fed winds up normalizing interest rates. By the way, normal interest rates would be very welcome as far as I'm concerned. There's no reason why we shouldn't be able to live with interest rates around 3%. We've done it before. We'll do it again. So technology, I think semiconductors, I think cloud computing is going to be a very big use of cloud technology. Artificial intelligence is another area that's very important. Energy, any opportunity to buy some of these high-yielding, dividend-yielding stocks in the energy area makes a lot of sense. Financials, I think we're going to see a wave of M&A activity in an environment where an economy is growing slowly. It's a competitive environment, and so there's a tremendous pressure for M&A.
Forgive me for interrupting, but I want to push back, if I may, on this semis idea. Because that seems to be an area that is a true battleground right now, with a lot more negative than positive around it. It is arguably the most cyclically sensitive part of the market right now. And some people think it's going down. That sector is by a lot more. Why isn't it?
Well, I think the consumer side of semiconductors certainly is challenged. There's no doubt about that. Everybody's got a cell phone. I don't know how many people want to upgrade to cell phones that cost $1,000, but I think the consumer is going to be an area of weakness. But enterprise companies, I think, are going to have to continue to spend a tremendous amount on technology in order to increase the productivity of a very scarce labor force. And I think companies have come around to realizing that these labor shortages are chronic and you're not going to be able to get more workers simply by paying them more. You really have to increase the productivity of the workers that you have.
I got it. All right. He is Ed Yardeni, the president of Yardeni Research.